In my last video, we talked about 9 reasons to buy Tesla stocks. It's great to be excited about making your investment, but it's also important to understand the potential risks associated with your investment. Today we are going to look at 6 reasons to sell Tesla stocks. Number 1. Increasing competition. As governments around the world are banning gasoline and diesel-powered cars, the market for electric cars is rapidly growing. Almost all traditional car companies have shifted their gears to produce electric vehicles. In addition, there are new companies like Lucid and Rivian. Lucid in particular is backed by the deep pockets of Saudi Arabia's public investment fund. The CEO of Lucid, Peter Rawlinson, was a former engineer at Tesla, and their technological prowess is quite impressive. Lucid was the battery supplier of all race cars in Formula E, and they are currently supplying the front drive unit that incorporates the motor, inverter, differential, and transmission. Naturally, Lucid's racing experience has translated into their passenger cars, making some Lucid models perform better than the top-of-line Tesla. Quite frankly, Lucid is copying Tesla's business model by introducing a high-end luxury sedan called the Lucid Air, which competes against Tesla Model S. Then they are going to produce a large SUV model called the Gravity that competes with the Model X. And lower price models that will compete against the Model 3 and Model Y are in development. Lucid is also copying Tesla's direct-to-consumer sales strategy by making Lucid stores around the world. Here, customers can view the cars and order them online, making the car buying experience a lot more pleasant. Auto manufacturers selling cars directly to consumers was prohibited by laws in some U.S. states. Tesla had to pave the way by going through lawsuits and convincing government officials. Then here comes Lucid to enjoy the fruits. Rivian is another rising star backed by the deep pockets of Amazon. Rivian builds so-called electric adventure vehicles, a fancy way of saying electric SUVs and trucks. They are the direct competitor of Tesla Model X, Model Y, and Cybertruck. All Rivian models are highly appraised by critiques and early customers. Rivian has a factory in Midwest, producing passenger cars as well as Amazon's electric delivery vans. Rivian's production number is slowly increasing. Other than Lucid and Rivian, there are many new electric cars threatening Tesla's sales around the world. Although the growing size of the electric car market has room for everyone. Each sale from a competitor is revenue taken away from Tesla. Number 2. Is Tesla's valuation too high? This is the golden question that everybody is wondering. The valuation of Tesla is subjective and dependent on many factors. But Ford's price-to-earnings ratio is 5.98 while Tesla's price-to-earnings ratio is 52.46. Price-to-earnings ratio is simply the price of one Tesla stock divided by earnings of the stock. Or you can also calculate it by the market cap of Tesla divided by the earnings. Typically, tech companies have higher price-to-earnings ratio because their business is more attractive, while car companies have lower price-to-earnings ratio because the car industry is less attractive. To explain this concept in depth, tech companies generates high return on capital employed. Their assets are light as they don't need to build factories. They have high gross margins. Their business is highly scalable and has a high barrier to entry. Many tech companies also have recurring revenue as their customers subscribe to their service. On the other hand, car manufacturing is not a good place to be. Car companies have low return on capital employed. They are capital intensive as they have to spend billions of dollars for building factories. They are sensitive to economy as people won't buy expensive cars during recession. And their products are not recurring purchases. It's a one-time purchase and the lifespan of a vehicle can be extended for many years. Overall, car companies are not attractive and that's why they trade differently than tech companies. There has been a strong debate whether we should look at Tesla as a car company or a tech company. Tesla produces solar panels and plans to expand their business into auto insurance and ride-hailing platforms. But currently, more than 80% of their revenue comes from automotive sales. Therefore, one could argue that Tesla's price-to-earnings ratio is too high. Number 3. People don't buy expensive cars during recession. Last few years, when the interest rate was low, the economy was booming. Everybody was looking for places to invest. From stocks to real estates to cryptocurrencies. Anything you invest returned high profits. Things have changed as the interest rate climbed. As the cost of borrowing money became more expensive, businesses started to cut costs and reduce their workforce. The value of stocks, real estates, and cryptocurrencies dropped. When you lose your job and the value of your assets decrease, the last thing you do is buying an expensive car. The cheapest Tesla is the Model 3. Without any options, the car costs $43,490. Instead of buying a brand new Tesla, many people are likely to buy second-hand cars. During a recession, Tesla's sales are likely to decrease. Number 4. Angry customers. In order to combat the decrease in demand, Tesla lowered their prices across their portfolio. This action caused angry Tesla customers to protest inside the Tesla stores in China, demanding their money back. During the Shanghai Auto Show, an angry customer jumped on top of a Model 3, claiming that Tesla fitted faulty brakes in her car, causing an accident that almost killed her. In Taiwan, a Tesla Model 3 using autopilot crashed into an overturned truck. The accident investigators concluded that the Tesla mistakenly viewed the object as white sky, due to the color of the truck. In February 2020, an Apple engineer in a Tesla Model X was killed when his car in autopilot crashed into a fixed concrete barrier. The driver was allegedly playing a video game on his iPhone while the car was driving. One could argue that Tesla is being irresponsible to release beta versions of their autopilot software, using their customers as test subjects. Number 5. Geopolitical issues. China is one of the biggest markets for electric cars. Therefore, Tesla invested billions of dollars to construct a gigafactory in Shanghai, which is one of the largest Tesla factories in the world. There are also over 56 Tesla stores in mainland China. However, the US and China are not in a good relationship these days. Recently, a Chinese spy balloon hovered over US nuclear missile facilities, causing an F-22 to strike it down. The Biden administration also announced the Inflation Reduction Act, which gives federal tax credits to customers buying electric cars made in the United States. The cars qualifying the incentives should not have critical minerals and components from China. These kinds of laws are only widening the gaps between the US and China. For example, China does not allow Tesla cars to be driven near their military compounds, as the cameras built in the cars could collect sensitive information. This means anyone working near the Chinese military cannot purchase a Tesla. Tesla needs all the support from the Chinese government to boost their sales and production. But the adversary relationship between the US and the Chinese government could hurt Tesla's business. Number 6. Elon Musk being irresponsible. Elon Musk is often viewed as a real-life Iron Man. However, just like Tony Stark, the richest man on the earth, acts like a maverick. He bluntly says what he wants on his Twitter, which gets him into trouble. A CEO of a publicly traded company does not have to share his political stance. But Elon openly supports the Republican Party. Considering the fact that almost half of the US population supports the Democratic Party, Elon's comments could deter Democratic customers buying Tesla. Besides, the current administration is a Democratic Party. It is not wise to have the government turn their back against Tesla while the company is based in the United States. In the year 2018, Elon tweeted that he could take Tesla private at $420 per share. His statement could have manipulated the market, as $420 was a substantial premium to its trading price at the time. As a result, Elon Musk had to step down as Tesla's chairman and pay $40 million in penalties. These are unnecessary troubles that could have been avoided by simply not tweeting. But for some reason, Elon couldn't help it. Whether you like him or not, Elon Musk is the innovator behind Tesla. When everybody was doubting the success of electric cars, he was the one who made the EVs mainstream. Simply put, Tesla is Elon Musk and Elon Musk is Tesla. Therefore, if something happens to Elon, or if Elon does something stupid, Tesla's share price is affected. Which means too much is at stake for one man. These were the 6 fundamental reasons why I think Tesla is a bad investment. If you have other reasons to invest or not invest in Tesla, please share them in the comment section below. This video is meant to help you understand the risks of investing in Teslas and save your time researching. Please note that the responsibility of your investment decisions are entirely up to you. If there are other stocks you'd like us to analyze, please let us know in the comment section below.